In this video, I'm going to tell you about the stock that I just bought for my dividend growth portfolio. I'll go over what the stock is and why I chose it. It's a high quality company that you're all familiar with, and it comes with a good dividend record, including a high yield. And finally, I'll demonstrate how adding shares of this stock to my portfolio improves it. Hi, I'm Dave Van Knapp, here for the Dividend and Income channel. Before I get started, I'd like to ask you that if you appreciate this content, please click the thumb up at the bottom of the video, subscribe to the channel, and also click the bell so that you get notifications of new videos as we publish them. Before I get started talking about the stock, I want to just give you an overview of the portfolio that it's going into. I call this my Dividend Growth Portfolio, or DGP. I started it in June of 2008, so it's approaching its 13th birthday. I started it with about $46,700 in 2008, and it's currently valued at $158,000. The primary goal of the dividend growth portfolio is income, reliable income, and growing income. It holds 28 stocks. It grows organically, which means that I've never added any more money to the portfolio. It has dividends flowing into it, of course, and I use those for reinvestments. I've never added new outside money. That makes the portfolio easy to analyze and isolates the effects of dividend growth investing itself as a strategy. Dividend reinvestments are every month, and that's what this video is about. The stock I selected for this month's dividend reinvestment is Verizon. It's a company you all know about. It's been my cell phone provider forever, since my wife and I have had cell phones. This display shows a summary of Verizon. I call it Verizon in a nutshell. Verizon is in the communication services sector of the economy. It's a giant company, what's called a mega cap. It has a 4.4% yield, a 5-year dividend growth rate of just 2% a year, been raising its dividend for 14 years in a row. It gets a quality snapshot rating, and I'll go into this a little further in a second, of 22 out of 25 points, which makes it an above average quality company. I believe that it's selling at a 7% discount right now. And currently, I already own Verizon. It occupies about a 4% position in my dividend growth portfolio. The business plan for the portfolio allows a position to run up to 8%. So I have plenty of room to add more shares. The only real downside to Verizon is the slow 2% a year growth rate. I know that some investors would not accept that. I do accept it because of Verizon's high yield at 4.4%. Just getting its first dividend puts you way in the lead over a lower yielding but faster growing stock. It would take some number of years actually for a stock, say, growing its dividend at 10% per year but only yielding, say, 1.5% when you buy it. It would take a long time, many years, for that faster growing stock to actually catch up to the money measured in dollars rather than in percent that you're getting from Verizon. Okay, this display shows a price graph going back 5 years for Verizon. On the graph, the squiggly black line is the actual price of Verizon over the last few years. And I have put dots on it, maroon dots, each place I've purchased Verizon over the past few years. As you can see, the price has stayed more or less flat, would be a fair way to describe it. So Verizon is a slow growing stock. Not only does it grow its dividends slowly, but the market has been growing its price slowly. And the reason is that its earnings grow slowly. 2%, 3% a year earnings increase is typical for Verizon. At the right end of that price line, I put a green dot, and that shows where I'm buying Verizon right now. As you probably know by now, I always search not only for high quality stocks, but I search for stocks that are priced at least fairly and preferably at a discount. This display shows how I assess Verizon's price right now. Its current price is $57.50, or it was when I made my purchase a couple days ago. I see it as 7% discounted at that price. I would assign it a fair price of $62. I would certainly pay that much for the stock, but I didn't have to. When I make my monthly dividend reinvestments, I'm using the money that I've collected in dividends in the portfolio from other companies in the month since I made my last dividend reinvestment. In this case, I had about $400 accumulated to make this purchase, and as this display shows, I ended up spending $345 of that. That got me 6 shares of Verizon to add to the shares that I already had in the portfolio. This display shows the impact on the income from my portfolio by adding the 6 shares of Verizon. The numbers shown are the annual run rate of the income in dollars, and you can see that adding the shares of Verizon increased that annual run rate by $15 per year, from $5,079 to $5,094. And now I'll give my little lecture that I'm going to give a form of every time I reinvest money in this portfolio. I know that $15 annual increase sounds small, but I do this 12 times a year. The $15 in this case amounts to about 0.3% increase in the annual run rate of my dividend income. But I ask you to look at it this way. When I do that 12 times a year, and if every reinvestment increases the income by 0.2 to 0.3% annually, when you add it all up, that means that my annual income is going to go up a total of 3% annually simply through the reinvestment of the dividends themselves. That increase in income is on top of the increase in income that comes from the fact that the companies in the portfolio all give annual dividend increases. In fact, at this point, in April of 2021, 12 of the 28 companies in the portfolio have already announced their dividend increases for this year. And throughout the rest of the year, the other companies, one by one, will announce their dividend increases. So, in other words, if every company in the portfolio froze its dividend, which they have not done and won't do, I would still get a 3% increase in annual income simply through the mechanics of reinvesting the dividends when they come in, or monthly as I do it. So the bottom line, the takeaway from that is to remember that the increase in income that you get from reinvesting dividends is on top of the increase that you get from the fact that the companies are raising their dividends every year. Okay, let's review what we've learned in this video. Number one, I reinvest my dividends monthly, and at the rate they're flowing in this portfolio, generally that amounts to several $100s a month. This month I had almost $400 to reinvest. I decided to add to my existing stake in Verizon. The money I had allowed me to buy 6 shares of Verizon that cost about $345. Those 6 shares will add $15 a year to my annual dividend income from the whole portfolio. I know that doesn't sound like much, but with monthly reinvestments like this, I am in effect increasing my annual income by 3% each year, and that's ignoring the increases that come from the companies themselves. Finally, the income growth that I get, and that you get if you do the same thing, from reinvesting dividends is on top of the growth in income that you get from the company's raises. And that wraps up this discussion of my April dividend reinvestment. I will be back in a week or two with my dividend growth stock of the month for May. Please remember to click the buttons beneath the video, and so long everybody. Thanks for watching.